This tutorial looks at the capital asset pricing model, or CAPM for short. CAPM is a formula that determines the expected return of an asset given the risk of that asset. It's calculated as follows. The expected return of an asset, let's call that asset A, is equal to the risk-free rate plus a measure of that asset's risk, which is beta, multiplied by the market premium, which is the return on the market as a whole minus the risk-free rate of return. Let's break down what this formula says. It says that the expected return of an asset is based on two things. One is the risk-free rate of return. So at a minimum, you must be obtaining, or this asset must give you the risk-free rate of return, plus some sort of premium or compensation for taking on risk. So where do we find each of these variables? For the risk-free rate of return, you can use a treasury bill. So some sort of short-term financial instrument that is almost guaranteed because it's from the government and it's short-term in nature. For risk, you use a variable called beta. Beta represents the systematic risk of asset A. What does that mean? It means, or it represents, asset A's market volatility. So how does asset A behave in relation to forces that affect the entire market? The return on the market would just be the percentage return of an index that's taken as a proxy for the market. So if you're looking at the Johannesburg Stock Exchange, it would be the return on the all-share index. The risk that we speak about in the capital asset pricing model, represented by beta, as we already said, is the market risk. It's the systematic risk. Recall that you can get rid of unsystematic risk by diversifying. And therefore, all assets or all portfolio have systematic risk. So the only compensation that you'll get according to CAPM is the compensation for the level or amount of systematic risk that you can take on. You will not be compensated for taking on unsystematic risk because you can diversify away unsystematic risk. So investors will only be compensated for the level of systematic risk that they take on, because this you cannot diversify away. So the expected return on asset A, if the following was in place, would be as follows. If the risk-free rate of return was 5%, the beta was 1.5, which means that this asset is more volatile to market forces than the average or the total market as a whole. And let's say the market as a whole, as represented by some sort of index, is 10%. If you've got the following, then the expected return on asset A, according to CAPM, would be, at a minimum, the risk-free rate of return plus compensation for the risk taken. The risk indicator is 1.5, that's your beta. The return on the market is 10%, and therefore the market premium is equal to 10% minus the risk-free rate Therefore, the expected return on asset A is the 5% plus 1.5 which is your beta, multiplied by the premium of 5%. So this gives you 5% plus 7.5%, and therefore the expected return of this asset is 12.5%.